The process of insurance has evolved to protect people's interests from uncertainty by providing certainty of payment in the event of a given contingency. The insurance principle is becoming increasingly popular and useful in modern affairs. Learning objectives. After studying this chapter, you will be able to outline the 7 fundamental principles that apply to insurance. Explain the meaning of principles of insurance. There are 7 fundamental principles that apply to insurance contracts in personal injury and car accident cases. Utmost good faith, insurable interest, proximate cause, indemnity, subrogation, contribution, and loss minimization. Let us try to understand each principle in detail with an example. Now let us understand the principle of utmost good faith. The doctrine of full disclosure is embodied in the principle of utmost good faith, which applies to all types of insurance. Both the parties involved in the insurance contract must disclose all details relating to the subject matter of the policy. This is a very basic and primary principle of insurance contracts because the nature of the service is for the insurance company to provide a certain level of security and solidarity to the insured person's life. If the insurance company provides you with falsified or misrepresented information, they are liable if the misrepresentation or falsification causes you to lose money. If you have misrepresented information about the subject matter or your personal history, the insurance company's liability is null and void or revoked. Let us see an example for the principle of utmost good faith. Mr. Harry purchased health insurance. He was a smoker and also alcoholic at the time he applied for insurance and failed to disclose this fact. He later developed cancer. In such a case, the insurance company will not be obligated to bear the financial burden because Harry withheld critical information. Therefore, in an insurance contract, both the insured and the insurer must act in good faith toward one another. The insurer and the insured must provide clear and concise information about the contract's terms and conditions. In this slide, we will explain the principle of insurable interest. In order for an insurance contract to be valid, the insured must have an insurable interest in the subject matter of the insurance. The insurable interest is a pecuniary interest in which the policyholder benefits from the existence of the subject matter and is prejudiced by the subject matter's death or damage. The following are the requirements for a valid insurable interest. To be insured, there must be a subject matter. The policyholder must have a financial relationship with the subject matter. The law should recognize the relationship between policyholders and the subject matter. The financial relationship between the policyholder and the subject matter should be such that the policyholder benefits economically from the subject matter's survival or existence and suffers economic loss if the subject matter dies or ceases to exist. For instance, if you are hit by a person who isn't on the insurance policy of the vehicle, do you file a claim with the owner's insurance company or the driver's insurance company? Owner's insurance company. This is a simple but crucial element for an insurance contract to exist. Another example is that the owner of a grocery shop has an insurable interest in the shop because it provides him with income. If he sells the shop, however, he will no longer have an insurable interest in it. Hence, in order to be able to claim the insurance amount, the insured must be the owner of the subject matter both at the time of contracting and at the time of the accident. At the end of this topic we learnt the 7 principles of insurance, meaning of principle of utmost faith and its applicability, Meaning of principle of insurable interest and its applicability.